We have now arrived at the fun part, forecasting the financial statements into the future. To do this, we will rely on the historical integrated financial statements that we've just prepared as a base. We assume the historical accounting data has some level of predictive ability for at least the near-term future. It is arguably the best source of data that we have to value Tesscow. For the detailed forecast period, that is the period from 20Y8 to 20Y2, we assume the historical accounting data has some predictive ability because this period is in the near-term future. Therefore, we will forecast each line item in the integrated financial statements over this period. However, when we arrive at the simplified forecast period, that is the period from 20Z3 all the way through to the continuing value base year, we assume the predictive ability of the historical accounting data declines. At this stage, we are looking so far into the future that we really are engaged in guesswork. A key principle to apply here is keep it simple. We only forecast the bare minimum number of line items that we need to calculate free cash flow. I have colored in the select few rows that we need to forecast over this period. You may notice that we lose a lot of detail in the forecast financial statements during this part of the forecast horizon. So how do we project the financial statements into the future? To do this, we will use forecast ratios. The ratios will be contained in the next tab, the Historical and Forecast Ratios tab. This process involves a few steps. Firstly, we have to think about what factor drives each one of the line items that we wish to forecast into the future. Next, we use this factor or driver to calculate historical ratios for each line item. The historical ratios are used as an input or a consideration to help us to determine what values the ratios may take over the future period. We then estimate the forecast ratios over the future period based on our expectations of the future behavior or pattern of the factor that drives each line item. Finally, we apply the forecast ratios to the driver to arrive at the values in the integrated financial statements. I would like to highlight 2 points at this stage. Firstly, it is important to identify the most appropriate and accurate driving factor possible for each line item in the financial statements. Why is this important? It is important because our estimates of the forecast ratios effectively embed revenue and cost structures and resulting margins, as well as financing structures, within the forecast financial statements. It is these structures that determine not only the free cash flow estimates, but ultimately the return on invested capital and return on equity for each year over the forecast period. Therefore, your estimates of the forecast ratios will have a significant and sensitive impact on the valuation. Secondly, the most frequent driving factor that forecast ratios are based on is revenue. Therefore, your estimates of the expected future growth rates in the company's revenues will have a significant impact on the revenue and cost structures and resulting margins that you have effectively embedded in the forecast financial statements. And consequently, those growth rates will have a disproportionately large impact on the valuation. If you're finding this confusing at this point, don't worry. It should hopefully make sense when we apply these concepts to the Tesscow example. We will do this next.